Welcome to our Taking Stock video for the week ending the 28th of April 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to your thing share market. Great to have you on board again, Jace.
Thanks for having me, Kien.
But before we get started, just a reminder, the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts, tables presented here today shouldn't be relied upon as a guide for future performance. Well, Jace, both the Australian and US markets, they appear to be taking a breather following the strong rally in March. Overall, investors, they appear concerned about the health of the regional banking sector and also the prospect of slowing economic growth, with the US Federal Reserve now expected to raise interest rates next week. The futures market is pointing to an 80% probability that the Fed could increase rates by another 25 basis points.
Yeah, it's interesting you say that, Kien, because here in Australia, the annual inflation rate for the March quarter slowed to 7% from 7.8% in the previous quarter. Now, this was partially driven by falling shipping costs and also heavy discounting across the discretionary items such as clothing and also furniture. Now, we've begun to see the lagged impact of rising interest rates on the retail sector, and the latest data suggests that investors really need to be mindful of investing in retail companies that have exposure to clothing, household goods, and also appliances. Although the core inflation rate of 6.6% is well above the RBA's target band of 2 to 3%, the market is anticipating that the RBA will hold the cash rate steady at 3.6% on Tuesday. So any surprise change from here would lead to further volatility across the market.
That's right, Jason. Despite this, we have begun to see signs of a recovery emerging across our star growth stock universe, possibly as the market anticipates a peak in the interest rate cycle. But you can see this with the chart on screen, which is displaying the growth to value style ratio of the Australian market. For example, if the line rises, growth is outperforming value and vice versa. And in just recent weeks, you can really see that growth is starting to outperform value.
And also from our previous discussions as well, Kien, interest rates tend to weigh on the performance of growth stocks. These companies tend to have larger cash flows into the future, and hence the present value of these cash flows are more sensitive to changes in the interest rates, which is used as a discounting tool for the present value.
In addition there, Jace, growth stocks are also benefiting from positive investor sentiment following better than expected results from growth companies in the first quarter US reporting season. Some of those positive results to emerge this week include Facebook parent Meta, also software giant Microsoft, and the e-commerce platform eBay.
Look, speaking about quarterly results, Kien, most of the resource companies have released their updates, and a few of the key themes stood out. Firstly, wet weather conditions impacted by the production of several miners, such as Regis Resources, Whitehaven, and Yancoal, but thankfully, none of these were star stocks. In addition, our portfolio avoided disappointing updates, which came from South 32 and also Mineral Resources.
That's right, Jace. And among the standouts, though, we had Gold Road Resources. They released their strong production and cost figures, and its result was further strengthened by its unhedged profile, which allowed it to take advantage of rising gold prices.
Overall, management commentary suggests that commodity prices are expected to moderate on the back of softer economic conditions. Hence, it is important to stick to high-quality miners with strong balance sheets and low-cost assets to mitigate these potential headwinds. We're also monitoring the resource stocks within our star income universe, especially with regards to falling free cash flow and whether they can sustain their attractive dividends over the next 6 months.
But moving on from rocks to paper, or should we say scissors, Jace, we have cut Bank of Queensland from our star income portfolio on the back of a cut to their dividends. And that's due to those additional provisions and also competitive headwinds to its net interest margins.
Forecast earnings are now down by 20% over the last 3 months, and this is expected to put further pressure on future dividends, which are projected to be around 42 cents. In fact, the payout ratio is expected to rise from 64 cents this year to 71% in FY24. Please refer to our analyst commentary for more information on the active risks. But for members who are interested in picking up the dividend, you may want to hold on to the stock by the 10th of May when the stock goes ex-dividend.
And speaking about some ex-dividend dates, Jace, I know that for the week ahead, you've got Arena REIT is due to go ex-dividend on the 4th of May. That's the same day that Rio Tinto is hosting its AGM. Also, next week, the bank reporting season is in full swing with NAB, National Australia Bank, on Thursday, followed by ANZ and Macquarie Bank on Friday. So it will be interesting to see how well they are operating, considering the intense pricing competition at the moment. In Under the Microscope this week, we take a closer look at energy heavyweight and star growth and star income stock, Woodside Energy. The company's first quarter result was largely in line with consensus expectations, and management reaffirmed production guidance for full year 23, which implies a production increase of around 18% on year. But despite this, the market is anticipating earnings to fall by close to 40% this year, while earnings expectations have been revised down significantly in the last 3 months, Jace.
Yeah, that's an interesting point that you pick up, Kien. The revenue and consequently earnings profile for Woodside is determined by the amount of oil and gas the company produces, what it sells, and what that commodity price is. So while the FY23 production volumes are forecast to increase, this growth is more than offset by the significant moderation in oil and gas prices. So for example, the price of Brent oil is down 33% from its highs, and this has been a primary driver for the negative forecasts in return on invested capital and also profit margins.
Also, Jace, just remember that the merger with BHP's petroleum assets is now completed, and although earnings should benefit from further cost synergies, the weakness in energy prices mean that the stock is at risk of not meeting our star growth stock criteria when it reports its results in August.
That's right, Ken. And also from an income perspective, the free cash flow is expected to drop significantly from 549 cents in FY22 to 85 cents per share in FY23. Now, this is well below forecast dividends of 236 cents per share, suggesting that the gross dividend yield of around 10% may not be sustainable. However, over the last 2 years, the business has accumulated $6.2 billion in cash reserves, and this equates to roughly 15% of Woodside's market capitalization. The surplus cash can help sustain any dividend profile that management may have in the near term.
Yeah, very interesting, Jace. Additionally, free cash flow estimates also incorporate capital expenditure as well, and that's associated with growth initiatives such as the Sangomar project located 100 kilometers from Dakar, or the capital city of Senegal in West Africa. These capital investments are expected to generate long-term value for shareholders and enhance the company's production capabilities, which in turn would support future dividend payments. As such, it's also pleasing to see free cash flow recover in financial year 24.
That's right, Ken. And also to note that consensus figures for resource stocks tend to be quite unreliable because they're predicated on commodity price assumptions which change continuously. For now, we believe the gross dividend yield of 10% provides an adequate buffer above the market in event of any dividend cuts.
I also noticed, Jace, that Woodside is trading at a discount to consensus price targets and is hovering around those low double-digit PE multiples. But investors should be cautious when relying on valuation metrics for resource stocks such as these. Remember, energy is a very cyclical sector, and forecast earnings and share price targets can change quite quickly.
That's right, Ken. And you can also see under Golden Rule 4 in the charts, where the consensus price target moves closely in line with the share price. In addition, low PE multiples may also mean that energy stocks are at the top of the commodity cycle, inferring that these stocks are not necessarily cheap. In the meantime, please read our commentary to understand the active risks of these companies.
And with markets pricing in a peak in the interest rate cycle later this year, a useful question for members is, what star stocks and sectors are beneficiaries of stabilizing interest rate expectations? Well, the answer here is not straightforward. because falling interest rate expectations in this case also corresponds to slower economic growth, which makes it more difficult for many companies to generate profits. Hence, ideally, you want to look for those companies with strong market positions and net profit margins, those with solid financial health and a defensive earnings profile.
Also as well, Kien, a slowdown in rates could provide some breathing space for companies with high debt levels because there is this perception that interest costs would stabilize. Stocks in this space include property trusts, utilities, and also infrastructure stocks. From our star stock universe, these stocks include Telstra, Spark New Zealand, Arena REITs, Charter Hall, Social Infrastructure, BWP, Charter Hall Long WALE, and also the APA Group.
We've also noticed, Jace, that technology sectors have recovered, and those quality companies in this sector should also perform well due to their large cash flows into the future and also high reoccurring revenue subscription models. Star stocks here include WiseTech, Altium, Technology One, Hansen, and Objective Corporation.
And also as well, don't forget about the healthcare sector, including stocks such as Pro Medicus, CSL, ResMed, and also Cochlear.
Yeah, they do have those defensive earnings in any type of market environment. And on the other side, though, you've got those cyclical retailers. Although low interest rates can lead to a rise in discretionary spending, the slower economic growth and the lagged impact of recent rate rises can offset much of this benefit. Rather, though, within this space, it's best to stick to consumer staples where cash flows are more defensive. Stocks like Woolworths, Coles, Endeavour Group, and Treasury Wines are prime examples.
And last but not least, let's not forget about gold stocks, especially if inflation remains high. Those on our star stock list include Gold Road Resources, Perseus Mining, and also Alkane Resources.
Well, Jace, there are plenty of stocks to choose from, but we hope our members found this question useful. And as always, feel free to contact our analyst team or attend our Lincoln Live session on Monday if you need further clarification on any points mentioned today. That's all we have time for, but thanks again, Jace, for your insights. It was quite valuable.
Thanks for having me, Kien. It's always good to share insights with our members.
And to summarize, there are signs that the growth style investing is returning as interest rates reach a peak in the cycle. But we can't be too complacent. We need to focus on those quality growth companies with strong financial health because economic conditions are expected to deteriorate. Take care and have a happy, healthy, and prosperous week ahead.